Hello and welcome to Options Simply in English Advanced Edition. Today we're going to be talking about premium selling strategies by implied volatility level. The first thing we're going to do is we're going to start with something that we already know. We know what an option price is, and we know that it's made up of intrinsic value and extrinsic value, also called time value. But this option price is also called the premium you pay to acquire an option when you buy it. We know that in-the-money options are made up of both intrinsic and extrinsic value, whereas at-the-money and out-of-the-money options are made up of only extrinsic value. So intrinsic value depends only on underlying price, and extrinsic value depends on underlying price, especially where the strike price is in relation to the underlying price, implied volatility, and also time to expiration. When we talk about premium selling strategies, what we mean are those option strategies with net selling of options. So as opposed to strategies with net buying of options, premium selling strategies are net short options. Those strategies profit from the underlying price remaining stable, so not moving a lot, remaining range bound or in a certain range. They also profit from realized volatility being less than implied volatility. So when you put on a position, for example, and then the implied volatility suggests that the underlying is going to move by 10%, if the actual underlying price moved by 3%, so realized volatility is less than the implied volatility, then these strategies are going to profit from that. They also profit from implied volatility contraction. So when you put on a premium selling strategy and you initiate it, and then later on implied volatility goes down, then your strategy is going to benefit from this. These strategies can be directional or non-directional. What we call delta neutral strategies are the non-directional strategies. But we can also have premium selling strategies that are directional. For example, selling a put, selling a call spread, selling a put spread, etc. Now, in terms of the Greeks, all the strategies that are premium selling are going to have these characteristics. The delta could be any, could be positive, could be negative, it could be neutral. Gamma is going to be negative. Vega is going to be negative. And theta is going to be positive. The only exception are long calendarized positions that are Vega positive and theta positive. And in this category, we're talking about long calendars and also long diagonal spreads. So basically what we have with a premium selling strategy is once we put it on, we want the stock price or the underlying price not to move a lot. We want the IV, the implied volatility, to go down. And we want time to pass without any significant price change. Now, if we're directional, we also benefit from the underlying price moving in our direction. But if we're talking about a delta neutral strategy, what we want time to pass without the price going outside the range that we established by initiating our premium selling position. Now we're going to talk about looking at the implied volatility level that we have in our environment, which strategies are the best or ideal to put on depending on whether we have a low IV environment or a high IV environment, or an extremely high IV environment. We're going to start by looking at the directionality of our positions. And basically what we're going to have everything that's bullish on the left, everything that's bearish on the right, and everything that's neutral, we're going to have it right in the middle. So any strategy that has a positive delta is going to go on the left-hand side. Anything that has a negative delta is going to go on the right-hand side. And everything that's neutral is going to go right in the middle. Now, in terms of implied volatility, we're going to have high implied volatility on the top and low implied volatility on the bottom. So all the strategies that we're going to start analyzing are going to go from strategies that are ideal for low IV on the bottom, and then as we go higher, they're going to be suitable for higher and higher levels of implied volatility until we reach the very top, at which point these are the strategies for extremely high implied volatility. So we're going to start right at the bottom, and these are strategies for low IV environments, and we're talking about calendars, calendar spreads, and also a double calendar. So a double calendar would be the ideal position for something that's neutral, and something that is bullish is going to be a calendar spread with calls, or a call calendar spread, and something that's a little bit bearish is going to be a calendar spread with puts. So what is a calendar? What you're doing is you're using two different expirations, a front month and a back month, and you're selling the front month and you're buying the back month. In the case of a calendar spread, what you do is you use the same strike price and you sell the front and you buy the back. So this one is initiated for a debit, and these strategies are theta positive and also vega positive, because you're long an option in the back month, which is going to have a higher vega, so it's going to benefit from an increase in implied volatility because you have more vega in the back and you're long that vega, whereas you have a lower amount or a lower exposure in terms of vega in the front month. So a calendar spread with calls, you go out of the money. So these are for the most part put on when these options are out of the money. So for something that's a little bit bullish, you put on a calendar spread with calls, you sell a front call, and you buy same strike price back month call. In the case of calendar spread with puts, it's the same thing. You only do it with an out of the money put. In the case of a double calendar, you're selling both an out of the money call and an out of the money put. And what you want to do is you want to have the current price or the at the money right in the middle. So you have a position that looks a little bit like a delta neutral strangle, but with a calendarized element. Now, if we want to take a look at a position that's a little bit more bullish, you can look at a diagonal long call spread, which is basically a long call spread. So long a call and then short another call that has a higher strike price. But then you take the long call and you push it to the back month, and that way you have something that looks a little bit like a cover call where you're replacing the stock portion with a long call, in this case an in the money call, a long in the money call that's in the back month. This is going to behave more or less like a cover call, and that's why it's also called a poor man's cover call. Remember, we're talking about a low IV position here, and diagonals are good for low IV because they benefit from an increase in implied volatility. Now, if we want to stay on the same topic and we want to have a very similar strategy, but the one that is more bearish, we want to go with a diagonal long put spread, which is the same thing as a long put spread, but with the long portion calendarized, so pushed to the back month, which is something very similar to a cover put. A cover put is a short stock plus a short put. In this case, we replace the short stock with an in the money long put that we pushed to the back month. So in this case, this strategy is going to benefit from an increase in IV because we have the long put that's in the back, which has a higher vega. Because of this, these strategies are positive theta, but at the same time, they're also positive vega. And this strategy in particular, the diagonal long put spread, is also called a poor man's cover put because, like as we were saying, It's like a cover put, but replacing the short stock portion with an in the money long put. Now, if we have a little bit higher implied volatility, we can start looking at different strategies. So for example, here, we're going to look at debit spreads. In this case, if we want to be a little bit bullish, we would go with a long call spread, and if we want to be a little bit bearish, we will go with a long put spread. In this case, what's going to happen is when we talk about debit spreads, we're talking about an at the money debit spread. So basically, long call spread where you're long a call and then short a higher strike, and in the case of a long put spread, you're long a put and then you are short another put that's at a lower strike. In this case, what we want to do is we want to have the current price right in the middle so that it's like a 50-50 shot. And we would have, in the case of a long call spread, we would have the long portion that's going to be in the money and the short portion that's going to be out of the money. Same with the long put spread. We want to have the long put that's in the money and the short put that's going to be out of the money. So the current price is in between. This is a little bit like a 50-50 shot. The theta is going to be slightly positive or even down to neutral. So basically zero. And we are in a very realistic sense. What we're doing is we're just taking a directional shot with this trade, but we're not going to pay for theta, and we are going to be using very little capital as opposed to taking an outright long position or an outright short position in the underlying. If we have a little bit higher implied volatility, then we would go from these debit spreads, we would go to credit spreads. In this case, we would have bullish position being the short put spread and the bearish position being the short call spread. The difference is, in the case of the credit spreads, we're talking about fully out of the money short put spreads and fully out of the money short call spread, where you have the price over here and then you're selling a put and then buying another put at a lower strike price. And in the case of a short put spread, this is a bullish position, and this strategy is going to have a positive theta, is going to have negative vega and negative gamma. All premium selling strategies have negative gamma. So these strategies don't like the price being very, very unstable and moving violently. They prefer, and they're going to profit if the price is more stable and if the price doesn't move a lot. In the case of a short call spread, this is a bearish position. You're selling a call and then you're buying for protection. You're buying a call at a higher strike price, and then you have this risk profile graph, and this position is going to be very similar to a short call, but you're protected with the wing, in this case with a long portion that's going to be at a higher strike price. Same with the short put spread. Now, if you have a little bit more implied volatility, you can start looking at strategies such as an iron condor, which is basically two credit spreads, a short call spread on the top and a short put spread on the bottom. And you have the price in the middle, and what you want is you want the price to remain in a certain range that's determined by the different strike prices that we select when we put on the iron condor. Now, if we want to add a little bit of directionality to our position, we can have something that is a skewed iron condor. We could skew it. In this case, for example, we would take the long put that's protecting the put side, and we would move it to a lower strike price. Therefore, we're going to be taking on more risk on the short, on the bottom, on the downside, which means that our iron condor is going to have a directional component and is going to be slightly bullish. The same thing is going to happen if we talk about an iron condor where we skew it, we take the long call, we push it higher, and then we're going to be taking on more risk on the upside. Therefore, the condor, the iron condor itself, is going to have a directional component and is going to be slightly bearish. Because if the price starts going down, and even if it goes down by a lot, we're not going to lose as much as we would lose if it goes higher by a lot. So this is how you can turn an iron condor into a directional strategy. Now, if we have a little bit more implied volatility, then we can go for an iron butterfly. And the reason why we consider butterflies or an iron fly or an iron butterfly instead of an iron condor, if we have a higher value of implied volatility, is because an iron fly is going to collect more premium and is going to have the short options right at the money. So they're going to have a higher vega, a higher negative vega. So if the implied volatility is higher, then the logical conclusion would be, knowing that implied volatility for the most part is mean reverting, we would expect this mean reversion to happen, and we want as much vega as we can get, and so that we can profit from it. Okay, so that's why if we have let's say a high but not very high level of implied volatility, we'll go with an iron condor. If we have a higher level of implied volatility, still not extremely high but high, we would go with an iron fly. Likewise, we can take an iron fly and we can make an iron fly directional by skewing it. And something similar to what we did with an iron condor, we would take the long put and we would push it lower in strike price so that we can take on more risk on the downside, and then get to a point where we actually don't have any risk on the upside. This would be a very bullish strategy, and one that is going to be selling premium, but also at the same time benefiting from a move higher because we don't take any risk on the upside. The same thing happens on the other side with a skewed fly on the call side. We would just take the call, the wing that's on the call side, and we would push it higher in strike price, so that now we have more risk on the upside, and we can get to a point where the credit collected is higher than the actual distance between the shorts and the long put. At that point, this strategy would have no risk to the downside. It's important to mention that all these iron versions of these strategies can also be replaced with long butterflies with all calls or all puts. So instead of an iron condor, we could have a condor, and instead of an iron fly, we can have a long butterfly, so a call butterfly or a put butterfly, and then we can have a broken wing butterfly in terms of the calls or on the put side, and same with a condor. We can have a broken wing condor on the put side, or we can have a broken wing condor on the upside. So I like the iron versions better because everything is out of the money. So it's a little bit better from the standpoint of liquidity and bid-ask spread. You're gonna get better prices, but you can certainly establish these same strategies with all calls or all puts by using butterflies, long butterflies, instead of the iron versions of these strategies. Now, if we have a little bit more implied volatility, we're going to start getting into the strategies where we take unlimited risk on one side, and we can take a look here at a Jade Lizard, which is the same strategy as a long put ladder. So basically what you do here is you sell a put and then you sell a call spread, and altogether all the credits add up to something that's more or higher than the width of the call spread. In this case, you're not taking any risk on the upside, and you're taking the whole risk on the downside. The same thing happens with a long put ladder, but instead of having a short call spread here, you would have a long put spread here. So basically you have this long put spread, and then the cost of the long put spread is going to be financed by selling another put that's at a lower strike price. These two strategies are synthetically the same. And if you really want to get a little bit more aggressive and more directional, you could go for a strategy called the Spiked Lizard, which what it is there's several ways you can look at a Spiked Lizard, but probably the clearest one would be that it's a butterfly with all puts that's financed by two short puts at a lower strike price. You can also look at this as a put ratio spread that is financed with another put ratio spread, where you take all the risk at a very low price, but you have a lot of risk because this line is going to be very steep, because now you have a lot of negative deltas, because you have four short puts versus two long puts. So this is a Spiked Lizard. It's a put, a long put here, two short puts here, another long put here, and two short puts over here. Okay. Likewise, on the bearish side, and of course, this is these are bullish strategies. You can see, you can look at the green color. Okay, they profit when the price goes higher. On the bearish side, we would have a reverse Jade Lizard, which is the opposite of a Jade Lizard. So in this case, you would have a short call and then a short put spread, and then all the credits added up are higher than the width of the put spread. Because of this, you're going to take no risk to the downside, and all the risk is going to be on the upside. This strategy is exactly the same as a long call ladder, which is basically you have a long call spread and then you finance it with a short call that's at a higher strike price. So you shift all your risk to a higher strike price, and anything that goes higher than that, you're going to start losing. And these strategies are, of course, they have unlimited risk because we have no wing on the upside. In this case, we're replacing the short put spread with a long call spread. And so these two strategies are synthetically equivalent. If we want to talk about a very directionally bearish strategy, we could look at a delta buster, which takes advantage of not only a high level of implied volatility, but also takes advantage of skew. What it is with the price over here, what you would do is you would buy a put spread and then finance it with the selling of a call spread. Because of skew, this put spread is going to be cheaper than this call spread. So basically what you're doing is you're buying something cheap and you're paying for it with something expensive. Because of this, you're going to shift the break even higher, and you're going to have a pretty big area where you're going to be profitable. And if price starts moving down, you're going to make profits. And that's why this is not only a premium selling strategies, because it benefits from a high IV, but also it takes advantage of skew, and it's a bearish, so it's a delta negative or a directionally negative strategy. Now, if we still have more implied volatility, we could shift into start looking at similar strategies, but now we're gonna talk about a big lizard, which is nothing but the same thing like a Jade Lizard, but you have both short options at the same strike price. So basically, you can look at this like a straddle, where you only buy the wing on the upside, and then the whole credit adds up to more than the width of the call spread over here. So therefore, you don't have any risk to the upside, and you have all the risk to the downside. This strategy is exactly the same as a put ratio spread, because here we have a short put and then a short call spread. In this case, this would be a short put and a long put spread, which is long this one and then short two of these ones. And then if the price goes lower than that one, lower than the break even, you're going to start losing money. So put ratio spread, same as Big Lizard. You have a lot of implied volatility. This is a directional shot to the upside. And if we want to get extreme, something that's very simple, you just sell a put. Short put, you have a high IV. If the price doesn't move, time passes, implied volatility goes down, then you're going to start making money, and you can take it off when you reach your profit target, or otherwise you keep waiting. And as long as your price doesn't go beyond your break even, if it expires at this point, you're going to end up making money. On the opposite side, you have the same strategies, but with a bearish directional outlook. So you have here a reverse Big Lizard, which is the same, pretty much the same as a Big Lizard. It's only to the other side. So you have like a straddle, something like a straddle. So you short put, short call, and then you have a long put on the downside, therefore capping your losses. And if the whole credit is more than the width of the put spread, then you're not going to be taking any risk to the downside. Everything is going to be, all the risk is going to go on the upside. Okay. This strategy is the opposite of a Big Lizard, but it's the exact same as a call ratio spread, where you have a long call and then you sell two short calls. The reason why these positions are synthetically equivalent is because here you have a short put, short call, and long put. So you have a short call and a short put spread. Okay. In this case, you have a short call and a long call spread. So a short put spread and a long call spread are synthetically equivalent positions. So you have the exact same position here. Okay. Now, depending on liquidity, the width of the bid-ask spread, you're going to select the position that suits you better. But essentially, we're talking about strategies where we have a very, very high level of implied volatility. Now, the extreme example in terms of direction would be a short call, where you just, the price is here, you take a call and you sell it. You sell an out of the money call. Now, if time starts passing and the stock doesn't move, you're going to start making money. You hit your profit target and you take it off with the profit that you were looking for. Now, in terms of implied volatility, if you put it on and implied volatility goes down because you're negative Vega, you're going to start making money as well. Now, as time passes, as long as you don't cross the break even at expiration, and if it expires in any of these prices in this area, you're going to end up making money right at the end. Okay, so extremely bearish, a short call; extremely bullish, a short put. And if you still have a higher level of implied volatility, you could go for a strangle. Simply, you sell a put, you sell a call, both of them out of the money. You're betting on IV contraction. You're betting on realized volatility being less than implied volatility. You're betting on the stock price not moving a lot, and you're betting on just time passing. Okay, so this is a strategy that's especially suited for very high IV environments. And the extreme example, when you have a the highest level of IV, would be a short straddle. You just sell the put, sell the call right at the money. Why? Because at the money has the highest Vega. And if you have a very high level of implied volatility, you would be looking at mean reversion at some point, and you want to take advantage of the highest Vega that you can get. And the highest Vega that you can get is right at the money. That's why if you go with a short straddle, you're going to capture the highest Vega that you can get in terms of a premium selling strategy. Now, you might think that when you have a short straddle, any price move is going to make you go in the money with your put or with your call. If it moves higher, then your short call is going to be in the money. If it moves lower, your short put is going to be in the money, which is true. But because the short straddle is going to bring you a very, very high level of premium. So for example, if you go from the straddle to the 20 delta strangle, we're talking about the strangle having a premium, a total credit of around 30% of the straddle. So the straddle is going to bring in a lot of credit, so a very high level of credit, and because of this, you're going to be able to profit much more quickly. So you're not going, if you go with a strangle and you're looking for 50% as a profit target, for example, with a straddle, to get the same credit, you would be looking at probably around 20% of max profit. So 20% of the total credit received, which is going to be very, very quickly attained if you just wait, because theta is going to be higher and because Vega is going to be higher. And if we're talking about extreme levels of implied volatility, chances are that it's going to start contracting very soon, and it's going to be very violently contracting to the downside. So the implied volatility is probably going to start going down very violently, and what you want to do is you want to have as much Vega as you can to capture those and turn those into profits. So these are, of course, there's many more strategies that you can do with options, and in particular, we're only looking here at premium selling strategies, which are the strategies that we concentrate on. You can have also premium buying strategies, buying call spreads, back spreads instead of ratio spreads, etc. But if you focus on premium selling strategies, this is more or less the way you would think of when you think of which strategy to apply when you identify which level of implied volatility is currently in the market. Now that you know this, you know more or less which strategy to go for depending on where the implied volatility is at any point in time. So I hope that this is a little bit helpful for you guys, so that you have the big picture of option strategies, so that you know which one to apply in which environment, and depending on which directional outlook you have for that particular underlying. And this is going to be available on my website, and it's optionsinplainenglish.com. I'm going to include my website in the description, so that you can go and get this graph if you so desire, and that's going to be available. And I hope that this is going to be helpful for you, and thank you very much for your attention. Goodbye.